Now, I think the next major opportunity in the markets is related to interest rates. And I think this opportunity will be greater than the opportunity we had during the GFC. So if you missed the GFC, if you weren't reading the Elliott Wave financial forecast then, if you weren't reading the Elliott Wave theorist and missed out on Bitcoin during this period, don't worry, there's always another opportunity. And the next big opportunity, as you're going to see here, is going to be in interest rates. I need to introduce you to the EWAVES software. I developed this software. It took me a long time. I've been working on it for the better part of a decade. And it does automated Elliott Wave analysis, so it can produce charts that look somewhat like this. They almost look like they were done by a human, but they are fully done by machine. And the way we achieved this was building a very large database of iconic historical Elliott Wave examples. And that database we could leverage to have the program learn from those examples. So why don't we use this program and take a look at interest rates, see what they're doing, and then maybe you'll understand what the opportunity is. Let me hit this button here. And there we go. 1, 2, 3, 4. And we're within wave 5 right now. This fifth wave looks a little different from, say, this third wave, because this third wave is an impulse wave. It's 1, 2, 3, 4, 5, with very sharp impulsive subdivisions here in 1, 3, and in 5. As you can see, if you know your Elliott waves, we've got a nice zigzag here in 2. We've got a nice triangle here in 4. We've got a zigzag here for this larger red 4 pattern here. But then if you notice, this first wave down in 1 of the red 5 that is forming is not a 5-wave move. It's not an impulse. It's in fact a WXY, a choppy overlapping move. Now, why is it that way? Because the market is forming an ending diagonal. Now, what is an ending diagonal? All right, if you want to learn about them, let's go to elliottwave.com, education, and let's go to Wavepedia and click on diagonals. Okay, now there's a lot of stuff here you can read about diagonals, but here's a diagonal in a bear market. This is the picture we have in interest rates. We've got from March 2020 here, we've got 1, 2, 3, 4, and then this is a diagonal, okay? You'll notice wave 4 tends to overlap wave 1. Wave 3 is not that aggressive. As you can see, it just kind of pokes a little bit below 1, and then 5 makes another little dip. And by the way, this structure, which used to be, we call them diagonals now, they used to be called diagonal triangles, because triangles under Elliott wave theory have something that occurs after them called a post-triangle thrust, which is a very aggressive move, and diagonals also have this thrust. So the move out of the diagonal tends to be very sharp. So this is the pattern that is forming here in zero coupon bonds. We've got 1 of the diagonal, 2 of the diagonal, 3 of the diagonal, just to a slight new low. We're in 4 now, and 4, of course, can end at any point in this price range. It just has to stop below 71.3. If we were to break out above this high, that would invalidate this fractal structure. But as long as it stays in this zone, turns back down and makes a new low below here, then we're going to have a setup for a completed ending diagonal that will in turn complete red wave 5, which will in turn complete the entire structure, this entire decline from March 2020 in interest rates, setting us up for a potential massive move up in these long-term treasuries and a decline in interest rates. When will we see this large rally in bonds? Well, what we can do is we can take this Elliott wave pattern, this unfinished ending diagonal, and extrapolate it. So let's click this button here. It says Explore Wave Targets. I'm going to click it. This wave is currently unfolding now, but it's not yet done, and it's going to imagine a place in both price and time where it thinks wave 5 is likely to end. And how does it do that? Okay, it's not magic. It uses medians. So it says, let's take this pattern, and then because, again, of our example database, we have an idea of that 50 percentile extrapolation point, where about half the time the market may overshoot it and half the time it may undershoot it, but it's the center of the zone of where we expect that market to go. So let's walk through here real quick to see where that is. All right, let's look at wave 1 first of the diagonal. Was back in July 2025 at 62.6. Then we've got wave 3, which was just a few weeks ago here in May at 60.49. Then, like I said, we're going up in 4, and then we're going to go down to complete this red 5. And the current projection is early October at 58.35. So that's our median point sometime in October. Now, there's an interesting thing that happens in October. October is the crash month. The crash of 1929 was in October. The crash of 1987 was in October. The crash of 2008, the steepest crash of the GFC, that was in October. For whatever reason, the seasonality is such that October is the crash month. Now, it's not the most negative month in a general sense. That's September. That is the month where the highest probability of stocks going down occurs in. But October is the month where if there's going to be a crash, that is the most likely month for it to occur in. And during the 1987 crash and in the 2008 crash, zero coupon bonds rallied hard. In addition to that, if you know anything about the stock market, you know that valuations are at their highest extremes in recorded history, far beyond what we saw before 1929 or 2000 or 2007. So certainly from a sentiment point of view, we are set up. Now, there's a few things that are important to understand. Although I'm saying bonds are going to rally hard, it's only treasuries, only the AAA government bonds. Now, one key thing that ending diagonals also provide is the ability to know when you're wrong. Like I said, if rates decline and break out above this 2, that would invalidate this diagonal formation. But if rates continue to spike into October after this temporary decline in rates is over, then the overall spike in rates has a limit that will keep this intact. And just so you know, that's when wave 5 is larger than wave 3, all right? Because ending diagonals are contracting. So see, this 1 is quite large and this 3 is smaller than 1 in both price and time. Well, 5 should be smaller yet. So if that's not the case and it continues to extend, then we may be looking at a much higher interest rate environment. In that case, it would invalidate this scenario. EDV is aggressive in a certain sense because these are the longest duration bonds you can get in the market. However, unlike shorting, at least it has positive carry. In other words, you're paid for your time in these because the yield is currently well over 5%. And if we get that spike, it'll be even higher. But EDV is still quite an aggressive end of the curve here. We can look at TLT, and this is shaping up exactly the same as EDV. We've got our 1, 2, 3, 4 working that ending diagonal. TLT's effective duration is less than EDV's. And of course, there are shorter duration bonds and ETFs out there yet. Now, the real opportunity, believe it or not, is not just here in bonds. Bonds are, I believe, the safest thing to be in during a deflationary crash because banks could be failing, companies are going bankrupt, but the U.S. government should remain intact throughout that kind of a crisis. Will there eventually be a crisis in treasuries? Absolutely, because the debt levels are large. But that's probably going to become after a private sector liquidation. The big opportunity here is the fact that the bonds should go up at the same time that stocks are crashing. So just for some context, in 2008, just by sitting in cash and avoiding this decline and then buying here at the low, that's equivalent to a 100% gain, right? Because you avoided a 50% loss. Now imagine combining that with zero coupon bonds, which we know in 08 they went up about 100%. and then buying at the low here, that's equivalent to a 300% gain. All right, that's a 4x multiple. And depending on the severity of the crash, it could be even more. If you look at the 1929 crash, that's a 10-to-1 decline right there, a 90% decline, right? If you combine that, if zero coupon bonds rally at the same time that this is happening, it could easily be a 20x opportunity. All right, so these are generational opportunities. Like I said, if you missed shorting in the GFC, if you missed buying Bitcoin in 2010, this is the next huge thing coming. So to take advantage of this, I really recommend subscribing to the Elliott Wave flagship services so that you're on top of what's happening in the markets and the economy. And also, if you really want a timing tool for interest rates, or of course many other markets, then I would check out EWAVES at ewaves.com. And you can subscribe for this service and follow this, because I think there's something huge that is coming soon. And with that, hopefully I'll see you guys on the other side of this.